morning, friends. Thank you, Pallav and PMS Bazaar team for hosting us, and thank you, Mr. Vikas, for a lovely presentation. You have made my presentation quite easy. The data points are quite similar. Thank you very much. What I'm going to take you through is the residential opportunity, which is going to be multi-decade opportunity in India. Just to set the context who we are, we are part of Blackstone. 65% of our company is held by Blackstone. We are a manufacturing distributor setup. We have primarily 4 products: private equities, hedge funds, performing credit, and real estate. All these products are distributed by in-house as well as external distribution partners. We manage assets over $9 billion. On the property fund, we started the real estate fund journey in 2009. We are a contrarian in nature. Post the global crisis in 2009, when the market was going through a counter-cyclical opportunity, we played the contrarian role and entered the real estate fund management business and lent money on an equity strategy. All the way up to 2017, we were primarily putting under equity strategy the monies. We raised our domestic funds starting 2009 all the way up to 2017. We raised our first offshore fund in 2016, and we moved into the debt fund strategy from 2017 for a simple reason. Post 2016, we felt the markets are overheated in terms of liquidity moving into the market for land purchase. And being a contrarian, we wanted to play a contrarian strategy on the consolidation which we anticipated to happen in the market. We are not Nostradamus, but we did predict that the markets will go through tough times because various economics papers were floating, and we felt that that's the right time for us to change the strategy, and we moved into a debt strategy, high yield debt fund strategy, and we also set up in 2023 our GIFT City route. Till date, we have raised over $1.2 billion, and we have completely invested and returned almost the entire capital back to the investors, and currently approximately $500 million of AUM size. We have one of the impressive exit track records, clocking 29 exit investments at 19% IRR and 1.9 MOIC. The most important aspect of the real estate fund management business, the way we do, is that we originate transactions proprietary. Both our debt funds have beaten the CRISIL benchmark performance by a significant margin. If you see the first debt fund on a dollar terms benchmark return is 5.8, where we are 11% and above. The second fund, which is a 2023 fund, has also beaten the benchmark fund. The key differentiators of ASK is the alignment. The team and sponsors alignments are very strong. We have invested our own monies over $25 million in this business. Risk and asset management is a very key aspect. I'll take you through the asset management separately as we speak forward. The risk and asset management is the most important thing for us. We believe in project execution and developer alignment to the fund as the key important aspects in our fund management business. Now let's set the context of what India presents to us. India currently is about $3.5 trillion and is estimated to go to a level of $27 trillion in 2047. What does that mean? Today, 9% approximately of the GDP is real estate. Out of that, the residential real estate is about $200 million. The residential sector is likely to grow at a level of 18% of GDP by 2047, and 55% of that would be residential. That means the residential sector contribution alone will be $2.6 trillion. To give you a context, India is $3.5 trillion today, and Indian residential market will move to $2.6 trillion. If you look at the per capita income, which is currently at about 2,000, is moving to $15,000 per capita income, which is 7-fold jump. What is fueling this economic growth? The first is the age. What used to be mid or early 50s age population for accessing mortgage loans have come to mid 30 age population. 65% of our population are under 35, and our middle class income is growing to the level of 60% as we go forward. Our rapid urbanization, which is currently at 28%, is likely to move to 40%. So we are creating, currently we have the top 8 cities contribute 80% of the GDP, and that will come down, and the tier 2 and tier 3 cities will grow. And if you look at the infrastructure push, which is very important because infrastructure push is driving the urbanization. What it used to be 1.7% in 2020 has already doubled. And in every 5 years, even if we double the rate of infrastructure push, we would comfortably touch the 26 trillion mark of GDP by 2047. Now let's look at the credit side. The non-banking finance company credit is coming down. It is currently at about $17 billion, and the bank credit is going high at $55 billion, put together $82 billion. And what you look at on the right side graph is the way the equities are raised by the real estate. If you look at the pattern, the 86% of the equity fundraise is happening at the non-core real estate asset class. The core real estate asset class is raising only 17% equity. This shows the real estate sector is deprived of the required capital. To put it in other context, India currently require anywhere between 10 to 12 billion dollar of money, or in a rupee terms 1,20,000 crore annual requirement. All AIFs put together have about 15,000 crores. 15,000 crores is available and the requirement is 1,20,000 crore. Hardly 10 to 15% of the capital is addressed for the sector. Now let's look at the two other economic drivers of the mortgages growth. India has reached to a $343 billion of mortgages, which is 11% of the GDP. Is it a right number for a country of our size? We should be ideally at 30% and above. Any emerging markets are at around 30% and above, and developed economics are well above 50%. So as we move to a $26 trillion economy, even at the current level of growth, the mortgages would stand at about $2.6 trillion. And imagine if it doubles, it will move to $5 trillion and there so. And the key aspect of AIFs, if you see, the total AIFs is $82 billion. And only 17% of this is in residential. And category 2 funds is a dominating factor here at about 65% of the total AIFs is from category 2. What is driving this country? What it used to be a very opaque structure in early 2000s or 2010s, India is no more an opaque structure. As Mr. Vikas said, the structural and regulatory changes are not forced. It is by design. The real estate sector has three stakeholders: investors, lenders, and the developers. Each one of them have gone through a structural and regulatory change by design. The investor community has dried up because of cash market going out and the restriction in set-off of house loan, property, adjustment of tax regulation in 2017 restricting to one property. So the investors are dried up. The residential market is completely captive users. Today when I handle my portfolio, we manage over 50 million square foot, approximately 23 to 25 live projects. We see 85 to 90% of the home buyers are captive users. Now look at the lenders. The lenders earlier used to have the traditional civil suit, Section 138 or SARFAESI Act to recover the monies. The insolvency code was launched in 2016 and the recovery of the loans have become easy. Under insolvency, when a debt is proven, the company is admitted into insolvency and the project is taken over by the lenders. That includes home buyers. The developers, the promoters are thrown out of the company. So the protection for the lending is far superior now. And for the developers, they are brought under a regulatory ambit which was never available in the country. RERA was introduced in 2017 and RERA has brought corporate governance and financial governance. For any projects more than 8 apartments, you must have RERA. Without all the regulatory approvals, you cannot launch the project. The project must have all the amenities, specifications, completion timelines to be specified with standard builder-buyer agreement. Any defaults on those attracts civil and criminal liabilities. The monies what you receive from the home buyers earlier used to go for farmhouse buying and Lamborghini cars buying. Today it cannot happen. The monies are deposited in the RERA account and the monies have to be spent for the project and the monies can be withdrawn only on submission of a certificate from an auditor and an architect confirming the construction progress and the monies you have spent for the construction progress. NBFC collapse in 2018 led to the reckless lending going out of the sector, aided by regulatory steps in 2022-23 by Reserve Bank of India, where they have said henceforth NBFCs cannot lend monies to the sector without the RERA approvals in place. They also stopped the evergreening of the loans. They also said if a institution along with its private equity fund have a common exposure to the project, the institution must fully provision the loan. The structural and regulatory changes has pushed the industry into consolidation. The consolidation is a simple thing. Once consolidation happens, the fitter one survives, the weaker ones surrender to the fitter ones. We relied on this theory. 2017, we raised our first debt fund under this theory. We are not Nostradamus, let me repeat, but we have an underlying philosophy that whenever there is an excess money goes into the real estate sector for land acquisition, that's the time you need to step back and see what's happening in the market. because excess supply of capital means excess money, means excess projects coming in, resulting in demand supply distortion, which leads to price distortion. If you look at some of these slides, if you look at the first slide, first time we are seeing absorption more than the supply. If you look at the right graph, top right, the inventories which were at all-time high in 2017, ranging 3 years to 4 years, that is the number of months it will take to sell the unsold inventory, have come down to all-time low. This is because tapered liquidity is gone into the market, resulting in moderate supply, aided by strong macro factors of low mortgage rates. Double-digit income growth is fueling the absorption. What we are also seeing is developer consolidation. Typically, developed economies will have the top 10 developers having 40 to 60% market share. We estimate India moving to that level. The way we have moved our strategy, earlier we used to do equity strategy, that is land buying. Today we are looking at high yield debt fund strategy, completely relying on the consolidation which is happening. This consolidation itself requires $10 to $12 billion of monies to resolve. We are looking to raise $2 billion assets under this strategy. We primarily focus on solution capital to complete a project or a growth capital to acquire the asset from a weaker developer. I'll give you 2 examples to understand that better as I go forward. Our core investment philosophy, we invest only in top 5 cities. We invest only in residential sector. We have a very robust underwriting mechanism with strong downside protection. Risk management and asset management is our forte. We are the only fund manager in the country where we have put in-house asset management team. The asset management team operates in each one of the city where I invest. They are civil engineers. They are masters in civil engineers by education. They understand the nuts and bolts of the real estate industry. They understand the local process, rules and regulations. They track time, quality and cost, which enables me to have superior control over the distributions. This is my first fund, first debt fund which I raised in 2017. As we speak, despite 2 years of COVID, the fund is fully exited on a dollar return of 11.3% versus benchmark return of 5%. My second fund is fully deployed. In the first year, we have received 1/3 distributions. This has again beaten the benchmark performance by a significant margin. I'll give you 2 examples of solution capital and growth capital. This is a project in Pune by a developer called 𝐚𝐜𝐜𝐸. In 2017, when market witnessed the crisis, one of the NBFC had lent 100 crore money to him and issued only 50 crore money. Because of the stress in their books, the NBFC decided to withdraw the loan. The developer has only 2 options, either to bring a solution capital to complete the project or surrender it to a stronger player. We, coming from a real estate brand crop for last 2.5 decades, knows this developer for long period of time, assessed this asset. We replaced the lender, put additional 30 crore working capital. 30 crore working capital is almost 1 year of construction cost, focused on project execution, and we made 21% IRR and 1.95 multiple exit. Second example of growth capital. This is a project in Bangalore. The developer was Golden Gates. He had defaulted with India Infoline. He approached our developer partner, listed developer Shriram Properties, to acquire the asset. The distress opportunities come at distress price. We acquired at 60 cents to a dollar. We launched the project. We exited the project at 20% IRR in 20 months' time at 1.24 MOIC. The beauty of both these opportunities are that both these investment opportunities are after approvals. In real estate sector, the biggest risk is the approval risk. Under the high yield debt fund strategy, we have eliminated that risk. With a strong Indian residential platform set and poised for a higher growth, we believe that we would be able to raise anywhere between 150 to 200 million dollars in every 12 to 18 months time. We have shown it in the last 5 years and we continue to do so. We are raising our third fund. We have already achieved the first close. We are closer to $100 million fund raised. We have already invested first deal in NCR at 21% IRR. 25% of the fund is drawn down, and we would be completing 40% deployment by March 25, and by December 25, fund will be fully invested. Thank you for your patience hearing.